Welcome to the deep dive. Today, we're plunging into something maybe a bit overlooked, sometimes even dismissed. Money market funds. MMFs, right?
Right.
When you hear investment, you probably picture, stocks soaring or maybe solid real estate. But what about let's say, the quieter side of your cash?
It's true. A lot of people, well, they don't really see MMS as real investments. I think it's because they don't screen huge, dramatic
Yeah,
returns.
no Lamborghinis overnight.
Exactly. But here's the thing. They absolutely are investments, and for some really smart reasons, actually.
Right.
So our mission today, let's clear up what MMFs really are,
Okay.
why they definitely count as investments, and who they're really perfect for.
Right. Let's unpack that perception then. So, at its heart, an MMF, it's a kind of mutual fund. Yeah.
Correct. It pools money, but instead of stocks, it invests in things that are very short term, very liquid.
Liquid meaning easy to get cash out.
Precisely. And low risk. Think of it like you're lending money, but only for a very short time, and to really stable borrowers.
Okay, stable borrowers, like who?
Well, instruments like treasury bills, that's basically short-term lending to the government. Very safe. Or high-quality commercial paper. Short loans to top-rated companies.
Okay.
Also fixed deposits, certain corporate bonds. The key is safety and, well, being able to turn it back into cash quickly. And importantly, for listeners maybe in places like Kenya, these are regulated
Regulated how?
by bodies like the Capital Markets Authority. They set rules, oversee things specifically to protect you, the investor. That's crucial.
That definitely sounds stable. But okay, how does putting money into something so, I guess, safe actually count as an investment? Where's the investing part?
Yeah, great question. Gets right to the core. First off, your money is actually working. It earns interest because it's being lent out through these instruments.
So it's not just sitting there like in a checking account.
Not at all. It's active. You're earning interest on those short-term loans. You're kind of like the bank, but without needing a huge building.
Ah, right. And it's not like I'm picking these T-bills myself, presumably.
Oh, heavens no. Like any proper investment fund, MMFs are professionally managed. You've got experts watching the markets, making the calls.
Their job is to balance preserving the capital with getting the best possible return within that low-risk framework.
Exactly. That professional management, that's a hallmark of a real investment. They're making decisions for you.
Okay. And you said low risk, but does that mean zero change, or can it still move a bit?
Good point. It is subject to market performance. You won't see wild swings like stocks, definitely not. But slight fluctuations, yes.
So you could theoretically gain a little or maybe even lose a tiny bit.
Marginally, yes.
Yeah.
It's not a guaranteed fixed rate like some bank products. And that potential for gain, however modest, and that slight exposure to the market, that's what separates it from just a simple savings account.
Right, right. And that brings us to a really interesting point, doesn't it? The comparison with bank accounts.
Oh, absolutely. Because many traditional savings accounts, let's be honest, they offer maybe, what, 2–3% a year? If you're lucky?
Sometimes less. It barely keeps up with inflation, if at all.
Precisely. And this is where MMS can really stand out. Depending on the market, of course, they might deliver somewhere in the range of, say, 8% to maybe 11% per year.
Okay, wait. 8 to 11%. Compared to 2 or 3, that's quite a difference.
It's a huge difference. Think about your emergency fund, or maybe cash you're holding temporarily for your business, earning potentially 3–4 times more. That's making your idle cash work much harder. It's like a quiet powerhouse.
Okay, that makes a lot of sense. So thinking about that, who really should be looking at MMFs? Who benefits most?
Well, they're fantastic, I think, for new investors. It's a gentle way to dip your toes into investing without the scary volatility of the stock market.
A safer starting point.
Definitely. And also just regular savers.
Yeah.
People who want better returns than the bank, but aren't looking to take on big risks.
And what about that emergency fund point?
Perfect for it.
Yeah.
You need that money to be safe, but also accessible, right? MMFs offer that liquidity and security, much better than under the mattress, and usually better than a basic savings account.
And I guess for freelancers or entrepreneurs too, parking cash short term.
Yes, exactly. If you've got operational cash you know you'll need soon, but not today. Parking it in an MMF lets it earn something while it waits, rather than just sitting idle before you reinvest it.
So clearly useful, but we should probably also be clear about what they aren't. Manage expectations, right?
Absolutely critical. MMFs are not a get-rich-quick scheme. Full stop.
Right. No doubling your money in a year. No building massive generational wealth overnight with just an MMF.
Definitely not. They're explicitly low risk and therefore lower return compared to, say, growth stocks. Their design is for capital preservation and steady, modest growth.
So ideal for the cautious investor, someone who really values keeping their initial money safe.
Precisely. Think of it like choosing a super reliable, fuel-efficient car. It gets you where you need to go safely and dependably. It's not the flashy sports car that might break down or cost a fortune to run. Both cars have their place.
That's a good analogy. So bringing it all together for our listeners, what's the main takeaway when you think investment? Maybe don't just picture the roller coasters.
Exactly. Not all investments have to come with heart-stopping risk. And maybe, just maybe, not all truly valuable investments need to be thrilling every single day.
There's value in stability, too.
Immense value. Looking at the bigger picture, MMFs show us that reliability, stability, consistency, these things matter in a balanced portfolio. They can be the calm anchor.
The steady part that lets you maybe take a bit more risk elsewhere or just sleep better at night knowing some of your cash is safe and still growing modestly.
Couldn't have said it better myself. It's about understanding the role it plays.
Okay, so here's a thought for you to chew on until next time. If someone tells you an MMF isn't a real investment, well, what might you ask them then? Something to mull over.